on and so forth. So you can see it both in the table format as well as balancing out in a debit and credit format. All right, so that's going to be that information. Next thing we have, we're going to record the income, the activity on the income statement basically for the year. So we're going to have one balance sheet account. That's going to be our balancing account. And then the income statement, sales, cost of goods sold, operating expense, salaries, guaranteed payment, capital account. You'll note that there's going to be different types of incomes. That's going to be the point. We want to point out the fact that when we flow through this information, the tax code is going to tax these at different rates depending on the type of income that we have here. So we want to keep that in mind as we go. So I'm going to say, here's this, and we're going to say, I'm not going to put this in terms of all the debits on top. I'm just going to put it in order as it's given us, kind of in order of what an income statement would look like in terms of a journal entry. This is basically summarizing the entire year in terms of an income statement. So first, the cash is going up. It's the balance sheet account. That's going to be the balance sheet account that kind of balances out the income statement here. So we're going to put the cash on top, and we're going to say that's for, we actually lost money, so it's going down 10,670. And then we had sales. So sales is going to be income. It's a credit balance account, so I'm going to paste that. It's going to be a credit, and sales was for a credit of 517. Always a credit when we're talking sales. And then we had cost of goods sold. Cost of goods sold, next amount on the income statement. It's an expense account. Expense accounts always have debits. So that's going to be for 451,000. And then I'm just going to put everything else into operating expenses. So everything else, operating expenses, will lump in there. So we can do it with one journal entry. And operating expenses are 77,000. Guaranteed salaries. So we're going to say guaranteed salaries. Salaries guaranteed. Use that. Okay, and I don't need it to wrap here. All right, guaranteed salaries is going to be 3,300, and then we've got the capital gains. So capital gains, it's a little bit out of order. So capital gains is going to be here, and that's going to be for 330. No, that's going to be for gains. It's a gain, not a loss, of 2640, and then we got section 1231. So notice capital gains is going to have to be broken out when we put it on to the K-1, and same with the 1231 gain will have to be broken out separately when we report that on the K-1 because it could have a different tax rate. Charitable deductions, another thing's going to have to be broken out separately when we report it on the K-1. That's going to be for 330. And then we got the municipal bonds. Again, going to have to be broken out separately because interest is may not be taxable if it's municipal bonds. So that's going to be income here. So if we're thinking about this in terms of normal operations, well, let's post this out, and we'll talk about that afterwards. So we're going to post this out. So now we're going to say cash. So cash is up here, and I'm going to make this. I don't know why that happen like that, make that. All right, we're going to double click here, go to the end of it, and plus. Cash is going down by that 10,670. And then we'll go down to sales down here. And sales is going to increase by the 517. Then we're in cost of goods sold. Cost of goods sold is going to increase by 451. So our gross profit is now here. Our gross profit is here, our net income. And our gross profit is here. This is ordinary income versus net income. Net income is everything. Ordinary income is going to be everything above here. So we'll see that as we go. So notice, and of course, this is income, not a loss. That's a credit, not a negative income. All right. So then we have the operating. Let's see. We're on guaranteed salary. That's going to be here. Guaranteed salary, and I skipped the operating. Operating is here. So operating is the 77. Then we have the capital gains, which is actually down here, capital gains. And that's going to be the 2640 income. Then we have the section 1231 gains. And that's going to be here, section 1231. And then we have the charitable contributions. And then we have the municipal bonds here. So we recorded all the activity basically on the income statement at one time. Now, if you're talking about normal business operations, that's going to be basically this information here, right? It's going to be sales minus cost of goods sold, all the other operating expenses, and we'll put guaranteed salaries in there as well, kind of like the salaries as well up there. That's kind of what our normal income from operations is. All this other stuff, charitable contributions, not really part of normal business operations, and that's why it's going to be broken out separately on the K-1. Same with the 1231, the municipal bonds, that's going to be interest type stuff. Capital gains, like selling stocks, oftentimes will result in capital gains as well as other transactions, but again, not normal type of business operations. That's why these are going to be reported down here. And if we look at total net income, it's all of this stuff here. So when we think about net income, it's this. That's what's going to have to be closed out. But when we think about breaking that net income out into the different formats because of the different tax rates, we're going to have to think about the fact that we have ordinary net income, and then we have this other random stuff that we're going to have to put in and put it in a different section on the K-1 so that we can then put it on the 1040 and represent it differently. Now we're going to do this a bit differently in that we're going to represent this income statement. Now I want to show this income statement in terms of our table over here before we see it in our capital accounts, because remember, we're not going to see it over here in the capital accounts, whether it be the books or the tax, until we close out the income statement. So let's see it in terms of our table over here, and we'll see the different formats, and we're trying to break out, remember, what the different types of incomes are, and then we'll close out the income statement to the capital accounts, and we'll see how it affects the capital accounts here. So let's do that. We're going to say that the ordinary income, we're going to break out ordinary income separately from the other income. Remember that the ordinary income is calculated here. It's going to be the sales, cost of goods sold, minus the operating and the guarantee payments. Now, I'm not going to say that this equals that number, because once we change this number, then it'll change our table. We don't want to do that. So I'm going to put it in the total column here. We're going to hard code it, and then we're going to allocate that out to the three partners. Now, note that this is actually a loss. It's a bit tricky because what we're saying here is the sales is less than the credits are losing. Sales minus cost of goods sold, operating, and the guaranteed payment means that the debits are winning. And on the income statement, that's kind of bad. So if we were to flip that, if we were going to say, okay, over on this side, we're saying it's a reduction to the capital accounts because it's actually a loss that we're talking about, and it's in the amount of negative 14.3. So then we're going to have 1/3 to each partner. So we're going to say that partner A is going to have that divided by 3, reducing their capital account for the loss. 14.3 divided by 3. And I'm just going to say this equals that number too. So we're going to have this allocated out in terms of a loss. That's why it's a negative number here, not a credit. Then we're just going to do the same thing for the rest of the information, breaking it out in the type of income that we have. The next one being capital contributions. Now this is a credit over here, which means on our table it's going to be income. This is income from capital gains, like selling stocks or something like that. So I'm going to hard code that at 2640. And then we're going to take 1/3 of that. So I'm going to take this equals this, divided 1/3 for A, and it's going to be the same number for B, same number for C. Same thing for 1231 gain. So it's a gain, 1231, 990. We're going to put the total in first. That's income, so we're going to put it an income increasing the capital accounts. And we have this same information here. So Excel kind of helped us out there with 1/3 each of the 990. And then we have the municipal bonds, so we're going to have to break that out separately. So that's going to be the 330. So 330 total, again, that's income. So we're going to represent the positive number. It's a credit here, it's a positive number here. And 1/3 of that across for A, B, and C. And then charitable. So charitable contributions for a is generally not going to be a business-related expense. It's going to be something that flows through differently. So even though this is like an expense, it's not really a business expense normally. That's why it's going to flow through on the K-1, so they can expense it on the 1040. And that's going to be for the 330. And that's going to actually be a negative here. It's going to reduce the capital accounts because it's an expense. And we'll take 1/3 of that. And there we have that. Now, once we close out the books, I'm going to do a normal kind of close here and close out the net income to the capital accounts here. And then we should tie out on a tax basis to these numbers here. So let's take a look at that at this time. So I'm going to scroll up. I'm going to highlight from J to Q. I'm going to unhide some cells so we have some room to do this right next to where we want to see it. So we're highlighting, right click, and unhide. So we're going to unhide, and then we can hide these. So highlighting these, and I'm going to go all the way, and then right click and hide. All right. So next step we're going to have here is to close out the income statement. So this is going to be the same type of journal entry. I'm going to close it out into the income summary first. Now I'm going to do this with just like two-step kind of method. We're just going to take all of these numbers are temporary now. We're going to close them out to the income summary. Then we're going to take the income summary, which will consist then of net income, and allocate it out to the owners. So that's going to be our two-step method. So all we're going to do is one long journal entry. It's going to look ugly, but all we're going to do is just take these numbers and reverse them in order to make it zero. Put the difference in the income summary being net income. So let's do that one at a time. I'm going to go sales. Sales is going to be up here. We're going to paste it 1, 2, 3. It's a credit here, so we're going to debit it to make it go to zero. And it's going to be 517000. Then we got cost of goods sold. It's a debit, so I'm going to copy that. And so therefore it's got this in it. We're going to credit it to make it go to zero of negative 451. Operating expenses. Expenses is a debit. So we're going to do the opposite thing to it to make it go to zero. We're going to credit it of 77. And then we got salary and guaranteed payment. It's going to be a debit. We're going to do the opposite to make it go down 33. Charitable contributions. It's also an expense, a debit. We need to make it go down. So I'm going to copy that. And that's going to be credit of 330. And then we've got the section 1231 gains. It's a credit. It's a gain. So we're going to do the opposite thing to it. We're going to debit it to make it go down to 0. 990. Municipal bonds. It's a gain. We're going to do the opposite thing to it to make it go down. 330. So we're going to debit it. And capital gains, same thing. It's a credit. We're going to do the opposite thing. Debiting it, making it go down. 2640. The difference then, if I was to add up the debits and credits, or if we did it this way, equals the sum of the debits minus the sum of the credits at this point, then the credits are winning by 10,670. So we need a debit of 10,670 to make this be in balance. What is that 10,670? That's our loss. That's our loss. So all we're doing is going to make all this zero and dump the net income on the income statement into income summary. So we're just going to put this all into one number. We're just grouping this all into one number. And I'm going to do our negative sum calculation to calculate that plug of 10,670. If I just sum all this up and flip the sign, that's the plug. That's what we need to make the debits equal the credits. Okay, so let's post this out and see if it makes sense that what we're doing here. So here's sales. It's got this in it. I'm going to double click here, go to the end of it, plus, and we're going to say that's going to clear it to 0. Cost of goods sold, we're going to say plus, going here, clearing it to 0. We got operating expenses here, plus the 77, making it go to 0. Guaranteed payment, plus the 33, making it go to 0. Here's the 330 plus this, making it go to 0. Here's the 990 plus this, making it go to 0. Here's the 330 plus this, making it go to 0. Here's the 2640 plus this, making it go to 0. The difference we're just going to stuff into income summary. So here's what our expense was. Now we just took all these numbers and said, hey, let's just squish them all together and make them one number we're going to dump into income summary. That's the net income. Now we can allocate that out more easily. Rather than just having the 3 capital accounts here and allocating out in this journal entry, we're just going to say now we have net income here. Let's just allocate, or loss in this case, let's allocate that loss to the capital accounts now in an entry that's a little easier to see. So this is a credit, we're going to have to, this is a debit, we're going to have to credit that. So I'm going to debit these 3 capital accounts. And we're going to credit the income summary. So I'm going to credit the income summary. And the income summary is going to be credited for the 10670, the loss. And then we're going to take 1/3 of that to the 3 partners. 1/3 of that to the 3 partners. So now the debits equal the credits. And if we close this out, this is just the normal closing process, except that we have to allocate it to the 3 partners. We're going to say, okay, A is going to get 3,557. B is going to get 3,557. C is going to get 3,557. And the income summary is now going to go down to 0. So now we've closed out the income statement. And now our capital accounts here, then, on a book basis are here. That's our book basis. Here's our tax basis. And that ties out to the table that we worked out on this side. Okay, so now we're going to take a look at the tax return. We're going to start off with the Form 1065. We want to see how the income is reported on the 1065 and then how it would flow through to the K-1s. Because remember, we're talking about a flow-through entity. How would we deal with these different types of tax rates as we go? So I'm going to go back to the Excel sheet. I'm going to scroll over here. I want to see these numbers again. I want to see the income statement down here before we close it out, using the income statement to report the taxes on the tax return. So I'm going to delete these last 2 closing entries so we can get that journal entry back, meaning we're taking it out of the closing process, putting it back into the income statement. I'm just going to delete that entry. There's our income statement before we closed. I'm going to pull this back over here. We're going to use that income statement now in order to do page 1 of the Form 1065. Now, we're not going to fill out everything on the 1065. I'm not going to put the name and all that stuff. I'm just going to put the numbers here. So we got gross income, the 517, that's a credit. We're going to put positive numbers on the tax return. We've got the cost of goods sold, 451. The tax return is going to have a subtotal of that. So we got the subtotal 66,000 here. We're going to have to break out the guaranteed payments separately. So here's the guaranteed payments. Here's the guaranteed payments. And then we've got the 77, that's everything else. That's this number here, everything else right there. The 3,300 plus the 77,000 equals the 80,003. The 66,000 minus the 80,003, that's the 14,300. Page 1 of Form 1065 ties out to ordinary income we calculated here being sales minus cost of goods sold minus operating expenses minus the salaries. That's going to be part of what we'll have to pull through to the K-1, and we'll take a look at that next time. Okay, so now let's take a look at the K-1. So I'm looking at the K-1 for one of the partners. We're going to say A at this time. So we're looking at our table here in terms of the calculation of the capital account, and we calculated the income portion of it down here to come up with the ending capital account. We're going to apply that to our K-1 here. So remember that K-1's what's going to be used to take the information from the tax return on the partner tax return, take it to the 1040. So here's the income broken out between one partner, partner A in this case. So we had a loss in this case, so that's going to go in box 1. We've got a loss here represented with the brackets. This isn't debits and credits, this is a loss. Then we had the guaranteed payments. Now, I'm going to assume the guaranteed payment went to A in this case. It went to one of the partners. If it went to A, then we'd have to break that out separately as the 3,300 guaranteed payment. The whole thing went to one partner. So just keep that in mind there. That's why it's not on this table here. Then we've got the capital gains. So capital gains is going to have to be broken out separately. We can't just put it into one net income number because there's a different tax rate once it flows through. Same with the 1231. So here's the 1231. Again, that's going to be taxed differently. So we're going to have to break that out. We can't just put it into net income when we break it out on the K-1. Then we got the municipal bond interest. Once again, it's going to be taxed differently. So we're going to have other, here's that one over here, tax exempt interest over here. So that's probably not going to be taxed because it's municipal bond interest. So even though it's income, it's not going to be taxed. And then we've got the charitable deduction. That's going to be an other type deduction. In this case, we're going to have to break that out separately so that can be flown through and flow through in the proper way on the Form 1040. Then we've got the self-employment earnings. Now remember, most of the earnings would be subject to self-employment, Social Security, Medicare on when it flows through. Normally it would be kind of the same as box 1, but because of the guaranteed payment in this case, we're taking the 4767 minus the 3300 to get that 1467. But the thing to remember is that this self-employment means that it's self-employment income, unlike maybe an S corporation where it would flow through and what was not reported as W-2 income may not be reported as self-employment income. So that's an important distinction that will flow through and have self-employment tax calculated on it. Of course, it's a loss in this case, therefore we don't really have the self-employment tax on the loss. But if it's income, then we would. All right, so then we have the information up here in terms of calculating the basis. So we're going to say, okay, basis calculation. We've got the partner share of the liability. So remember, that's going to be that we're going to say it's a qualified non-recourse financing. Therefore, it's going to be included here, and we're going to say that the liability went on the books for the 26, and then remember we paid off the 6,000, so it's this minus this. That's how we get the 24,667. That's that portion. And then down here we've got the capital that was contributed. That's this number here. Then we've got the current year increase decrease. Now that's not going to be the ordinary income. That's everything. That's all the income and expenses allocated. That's like net income allocated to A. So here's the loss, capital gains, 1231, the bond interest, charitable deduction adds up to this 3557. That's the 3557 loss. So then the 100, the 3557 adds up to the 96,443. And of course, if we add those up, we're going to say the 96,443 plus the 24,667 adds up to the 21,110. There's the 21,110, our calculation for A's capital account broken out on A's K-1. Of course, I didn't add everything else in there either. I just kind of given an idea of how these numbers would be broken out and flow through in terms of the financial statements and the tax return.